Okay, welcome back students who are taking financial accounting, and in this series of videos we are working on the assigned homework problems from the digital study guide for chapter 12, the group B problems. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, then that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help you if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. And so problem 37B. Horizontal and vertical analysis. And so net sales, net income, total assets for a 4-year period are. Okay. Compute the trend percentages for each item for 2011 through 2014. Use 2011 as the base year. Compute the return on assets for 2012 to 2014, rounding to 3 decimal places. And then Regal's main competitor had a return on assets under just under 12% for the years 2012 through 2014. How does Regal Clothing Emporium's return on assets compare with its main competitor? Right? And this here, in comparing one company with another, you can't compare amounts. You can take a look at 2 balance sheets and it doesn't mean anything, right? They're just numbers. By converting things into percentages, now you're taking, instead of comparing apples with oranges, you're comparing apples with apples, or you know, pears with pears, or bananas with bananas, right? You can't take and look at financial data as raw data from 2 different companies and make judgments about them. You generally need to convert them into ratios and percentages in order to be able to make a like comparison. So let's see here. All right. All right. So we need to compute the trend percentages for each of these items. So 2014, 2013, 2012, and 2011. Okay, so we have net sales, net income, and ending total assets, right? And if the base year is 2011, that means it is 100%, because that's the base, right? So basically what we're doing here is we're taking, one number and dividing it by the other number. In other words, for net sales for 2012, I have 1150 and I'm dividing it by 1025, and that gives me 112%. So this here is just number crunching, okay? To be honest with you, you can sit here and do the math, okay? And it's kind of a good exercise to do the math, to know where you're getting the numbers from. 53 divided by 49 gives me 108%. And 550 divided by 500 gives me 110%. And then I'm going to do the same thing going into the next year, okay? I'm going to take the 1200 and divide it by the base year, okay, of 1025, which gives me 117%. 77 divided by the 49 gives me 157%. The base year is 49. 620 divided by 500 as the base year gives me 124%. Now I'm not going to, in interest of saving time, the solution has the percentages. So I'm going to just write those in, but you get the idea of doing the math because I don't need to spend time doing math here, especially this basic math. Okay, so that's my trend percentages. Now, compute the return on assets for 2012 to 2014. Okay, so my return on assets, actually let me do this in blue. So my return on assets for 2012 through 2014, right? So remember, what's the formula for return on assets? Okay, it is your net income over your average total assets. Okay, if you didn't know that, look it up in the book. I actually had to look it up in the book, right? I mean, I had an idea because I'm thinking about return, which would mean net income, and it's on assets, so it has to be my average total assets. So just by looking at the words return on assets, I had an idea as to what the formula should be. But if you can't intuitively deduce that, you need to go and look in the book to see what that formula is. Right? So for 2012, okay, because remember we have to do 2012, 2013, and 2014. So for 2012, my net income, right, was 53. And my average total assets, all right, well, the end of 2011 becomes the beginning of 2012, so that's 500 plus the 550 divided by 2, right, so that's 1050 over 2, which is 525, so 53 divided by 525 gives me 10.1%, right? So 10.1%. Right, pause the video because I'm going to erase this. And so doing 2013 and 2014 is basically the same thing. You just, if you know where the numbers come from, all you're doing is just replacing them. So I have 77 divided by 550 plus 620 over 2. And when I do all of that math, I end up with 13.2%. And it's the same thing for 2014. I have 82, and that's over 620 plus 650 divided by 2. I do all of that math, and I end up with 12.9%. Okay, so pause the video because I'm going to erase that. All right, so we've computed the return on assets, right? And Regal's main competitor had a return on assets of just under 12% for the years 2012 through 2014. How does Regal Clothing Emporium's return on assets compare with its main competitor? Right. And this is the crux of doing this. You're analyzing the information, and you are it allows you to compare it with something else. If the competitor had 12%, well, in the year 2012, Regal underperformed. Okay, it was less than would be, let's see here, 10.1%. So yeah, Regal would be less than the 12%. Right? So Regal underperformed in 2012, but in 2013, okay, So this is a negative, but in 2013 it performed better than its competitor, and in 2014 it performed better than its competitor, right? So the trend is that it looks like Regal will continue to outperform its competitor, even though it had a jump here from 10 to 13%, right, and then had a slight dip, right? So that's a negative here. This is a positive. Even though it had a slight dip in going from 2013 to 2014, it still outperformed its competitor, who was a flat 12% across the way. So when you're comparing apples with apples, this would be a positive for Regal, or any investor who's looking at the information. They would look upon that and say that's something favorable to that particular company. Okay. All right. So that's it for this video. If you didn't understand something, go back and watch the video again. A lot of number crunching, to get to the analysis aspect of it. But if you still don't understand something, feel free to telephone and speak with an instructor.